Now, Bob, these are not, by the way, Unlimited's first hedge fund ETF products. They are adding to a suite that you already have. What exactly is the reasoning behind putting ETF strategies and hedge funds together?
Well, I think for a lot of particularly financial advisors and other investors, 60-40 was easy for a long time. But we're now, in many ways, reaching sort of the limits of 60-40. I mean, the bond sell-off that we've seen and weakness in the last couple of years highlights the fact that maybe bonds aren't the right diversifier to your equity portfolio, and instead, it may be better to look for other alternatives across alternative strategies. And the question is, when you're looking at alternative strategies to fold into the portfolio, do you want to invest in strategies where, from mutual fund managers, or do you want to find the smartest minds in the world, hedge fund managers spend billions of dollars a year beating the markets, and get that into your portfolio? And that's what we're really focused on, is every investor with access to hedge fund strategies at a low cost in that ETF wrapper.
Now, past performance doesn't guarantee future results, and we know that hedge funds have had some problems in the past, but the sophistication level of hedge funds, Bob, has always been something that's been prohibitive for average investors. There's a whole reason why accreditation had to work, right? You had to make a certain amount of money a year or have a certain portfolio size in order to engage in hedge fund strategies. This makes it available to everybody. Is that a good or a bad thing?
Well, I think it's, in general, a good thing. The reason why accreditation was so important is because the structure of a lot of those products were such that, say you invest and maybe there's a long period of lockups, or they're structured in a way that's particularly tax inefficient or requires a lot of paperwork to sift through. That's all things that require a sophisticated investor to assess whether or not an individual manager is acceptable. We've seen a heck of a revolution in the ETF space, where we can get more and more sophisticated strategies into that ETF wrapper, particularly with some of the regulatory shifts that have happened. And an investor doesn't have to go through the sort of due diligence that's necessary in a particular LP structure or have their money locked up for a long time. And so by relieving some of those core attributes of traditional hedge funds, by using the ETF wrapper, it makes it much more accessible and practical for the everyday investor.
Now, Todd, you work with a lot of institutional investors, whether they're 40 Act companies like mutual fund ETF type managers, or even some hedge fund clients as well.
Right.
What exactly are you seeing in terms of the marketplace and how it's developed with regard to how hedge funds operate, and whether or not those hedge fund strategies are still at least effective in trying to seek alpha, finding that outperformance?
I think on the latter, there's two stats I would point out to you. You have 10 stocks that are almost 40% of the S&P 500. And if you tack on, say, large cap growth or thematic AI, you own a lot of those stocks. And then you only have defensive sectors, energy, healthcare, staples, utilities, making up 20% of the S&P 500. So I need something differentiated. I need uncorrelated strategies like a hedge fund type strategy or managed futures. That's where that makes sense. And then in suppose your first question, ETFs are where money's going. There's no doubt about that. Mutual funds continue to see outflows. There are a few still star hedge fund managers out there, but the bulk of investors want lower cost investment vehicles. That's where the ETF comes in, and you're seeing that in the flows, whether it's equity, fixed income, and alternatives today.
Now, funds and the fees that go along with them have long been a debate point for many people, whether they're in mutual funds, ETFs, or in hedge fund type products. When it comes to the fee structure that you put in place for a hedge fund product, which I think 2 and 20, right, in my head, and then you put it into an ETF wrapper, where I think, I mean, they vary, but generally speaking, passive ETFs, are they very low cost in terms of their fee structure? Where does a product like Unlimited's hedge fund ETFs fall in that fee spectrum?
Yeah, so as you mentioned, most hedge funds, what they're doing is they're charging 2 and 20, a 2% fixed fee, 20% of the performance. And the challenge with that is that means that most hedge fund managers basically take all the alpha that they generate, leaving investors not much better off than they would be on their own. One of the nice things we can do, because instead of hiring star portfolio managers and paying them millions of dollars, we use technology to understand how they're positioned, and then we take that understanding and put it in the ETF wrapper. And so we can charge a lot less than a traditional hedge fund while still benefiting from all the insight that those various hedge fund analysts are bringing to the table. And so we're charging a 95 basis point management fee on a product that's typically, our new products run at sort of 2x the target return of a traditional hedge fund strategy. That adds up to something like 1/10, roughly 1/10 the fees that you'd get in a traditional hedge fund vehicle. Not to mention the fact that it's much more tax efficient to be in the ETF wrapper.
Now, strategy-wise, I had mentioned before that there are a number of products that Unlimited Funds has unveiled. And Unlimited, by the way, is not the only ETF provider out there who's trying to mimic hedge fund strategies. When it comes to your particular products, can you take us through what exactly was the thinking behind putting the products together that you have? You're looking at things like long-short equity. You're looking at things like global macro. You're looking at things like model-driven funds, like CTAs, commodity trading advisor, momentum-following strategies. How exactly did you put the product suite together, and what exactly was the, I guess, the feedback or demand from the investors that you talked to in advance of rolling these products out?
Yeah, I mean, we've had our flagship product, HFND, in the market for a couple of years now, which really proved out the fact that our technology can capture how those managers are positioned in real time. But that's really, in a lot of ways, I like to say it's the SPY for hedge funds. You know, it's just meant to capture hedge fund returns at a lower fee. I think for a lot of advisors, they basically see two challenges with sort of hedge funds as they come out of the box. One, hedge funds typically target sort of bond-like risk, lower risk because they're managing to an institutional benchmark. And two is a diversified strategy doesn't let advisors sort of pick and choose how to complement their portfolio. And so with our new product line, we're breaking out the individual hedge fund strategies into the pieces that you say, equity, long, short, global macro, managed futures. That, from a risk perspective, represents about 90% of the risk in the hedge fund industry. And we're taking that and turning up the target return to a 2x target return, something more akin to equity volatility, which is a lot more cash efficient for advisors building a total portfolio.
From a strategy and technical perspective, are there certain strategies that you observe in the course of your daily work, Todd, from a hedge fund standpoint, that you see as being perhaps more effective at generating outperformance in this market right now? I mean, the macro market has been very volatile and uncertain, but is it something like picking convergences and divergences in things like long-short equity? Or is it in training yourself to kind of look for certain patterns in the rates market and what happens in corporate credit? Or is it something as simple as just saying, hey, you know, this has been going up for a while, it's going to stay that way, let's keep going with it?
Yeah, I think it's very, you have to be agnostic to headlines today because it's 24/7 cycle. We've seen everything thrown at this market. And I think a strategy like managed futures makes sense where you're going off of signals. You're not going off of the news. And if I see agricultural commodities rising, or if I see bonds rising for whatever reason, I'm getting involved there. It's for that uncorrelated exposure and that news agnostic exposure. I think that's super important today just because the amount of noise that's out there, whether it's coming from geopolitical or the administration, right? So I think it's just a go with the momentum type of market right now.